Hi there and welcome back to the channel. Listen, if you're looking to reduce your tax bill and grow your wealth at the same time, you're in the right place. In today's video, we'll be looking at 5 investments that, if you make them, can immediately reduce your taxes and save you thousands of dollars. Let's get things off with the traditional IRA. Now notice we're specifying the traditional IRA, not the Roth IRA. The tax savings we're about to cover do not apply in the case of a Roth IRA. When you contribute to a traditional IRA, you can deduct the amount of your contribution from your taxable income. This in turn is going to lower your tax bill for the year. Now, the IRA does have limits as far as how much we can contribute each year. For instance, for 2024, the IRS allows you to contribute up to $7,000 if you're under the age of 50 or $8,000 if you're age 50 or older. One of the main perks of a traditional IRA is that your contributions grow tax deferred until you withdraw them in retirement. This means you don't have to pay any taxes on any of the funds or any of the gains in your IRA until it's time for you to withdraw them when you retire. Now, I do need to note that your ability to deduct contributions may be limited if you or your spouse are also covered by a retirement plan at work, or if your income exceeds certain levels. Next up is the Health Savings Account, or HSA. An HSA is a savings account that lets you set aside pre-tax money for qualified medical expenses, and it works by reducing your taxable income. To qualify for an HSA, you need to be enrolled in a high deductible health plan. Now, like the traditional IRA, there are some contribution limitations to an HSA. In 2024, you're allowed to contribute up to $4,150 as an individual, but families can contribute up to $8,300, and taxpayers who are age 55 or older could contribute up to an additional $1,000. HSAs have several tax benefits. First, the contributions are tax deductible. Second, money grows tax-free inside the HSA. Third, you don't have to pay taxes on withdrawals as long as those dollars are used for medical expenses. But after age 65, you can withdraw and use HSA funds for any expense, whether it's medical or not, and you won't be penalized. The next investment we're going to cover is the 401k. A 403b plan is also going to fall under this tax strategy. Now, these are both employer-sponsored retirement plans that allow you to save for retirement while at the same time reducing your taxable income. Your 401k and 403b contributions are made with pre-tax dollars, which means they're deducted from your paycheck before taxes are taken out. Now, for 2024, you can contribute up to $23,000. If you're age 50 or older, your contribution limit rises to $30,500. Contributions to 401ks and 403bs grow tax deferred just like the traditional IRA, but the contribution limits are much higher when compared to an IRA. Now, keep in mind, when you withdraw funds from these plans in retirement, those withdrawals will be subject to income tax. Also, if you take money out of these plans prior to the age of 59 and a half, you could be assessed an early withdrawal penalty. Next up are donor advised funds, or DAFs. These are accounts that are set up for charitable giving, and they are going to allow you to fund the account either with cash or assets like stocks. When you contribute to a DAF, you could deduct your contribution value immediately, but you don't have to donate all of the funds at once, and you can spread your donation out over time to different charities. Before you contribute to a DAF, however, you do need to know that those contributions are irrevocable. That means once the money is in a DAF, you can't take it back. But the tax benefits and the flexibility of supporting causes you care about and at your own pace can make it a fantastic option for both giving and for saving on your tax bill. Now let's shift gears to real estate. Investing in real estate has become a very popular strategy for producing income, but it can also provide some significant tax benefits. Whether you invest in long-term rentals where you have tenants or in short-term rentals like Airbnbs, real estate can provide huge tax savings. If you own rental property, you can deduct expenses like your mortgage interest, property management fees, real estate taxes, repair and maintenance costs, and much more. Plus, there's depreciation, which is going to let you write off the value of the property over time. Real estate can also grow in value over time, which adds to your wealth. So keep in mind, though, that real estate investing does have its risks. One of those being that real estate is less liquid than some other investments, meaning it's harder to convert into cash. Still, the tax savings from the depreciation alone can be a game changer. There you have it. 5 investments that work to slash your tax bill and increase your wealth at the same time. Guys, if you found this video helpful, I'd love if you could give it a thumbs up, subscribe to the channel, and hit the bell icon so you don't miss out on more tax savings tips and strategies. Also, let me know in the comments which of these investments you'd like to learn more about, and share this video with someone you know who could use these strategies. Thanks for watching, and I'll see you in the next video.